additionally, there was a diplomatic flaw. Trump's visits to China in May established a constructive strategy stabilization and significantly easing the market fears of extreme trade frictions and anchoring long-term energy trade expectation. So crucially, this geopolitical storm did not derail China's decarbonization, at least in the right-hand side. Actually, it accelerated it. And the first hard policy reveals a clear dual-track approach. And only 4 traditional industrial policies were issued, and largely preserving the state's stated quotas to shell the refiners during the crisis. And in stark contrast, 9 major green energy directives were aggressively rolled out. And yeah, on March 11, the MIT, actually, this is administration managing the whole industrial sector, and the NDRC, these two administrative jointly issued the action plan for the upgrading and transformations of legacy petrochemical facilities 2026 to 2029. That's what we're calling the 15th five-year plan. And I urge our global trading partners in analysis to pay close attention to this, as it fundamentally rewrite China's future refining supply landscape and crude procurement scale. And following the these nationwide assessments in June 2025, targeting units operating for over 20 years, over 600 petrochemical facilities were placed on a mandatory upgrade or elimination list, heavily concentrated in the traditional refining and the basic, just mainly the basic chemical rather than the high end. Lock on to the 3 core dimensions. One is what is the oil inventory level? This detects whether domestic refiners will pursue restocking the procurements or destocking the consumption over the next 2 or 3 months. And it may be varied by the refiners. It may not be one for all. The story may vary by the buyers, the refiner side, and directly impacts the strength of the spot premiums for the Middle East and the West African crude. And what is the real? The second is the demand. What is the real demand and crack spread? That's the margin for the refiners. And the strong terminal demand is the higher. The higher the refining margins we go, incentivize the refiners to increase the run rates and pull into the crude run imports. And the final question is, when will be the concentrated crude procurement window? That's given what is the price. So there's just 3 key factors. One is the inventory. Second is the demand or the margin, refining margin. Third is the price. China have to buy, but is it urgent to buy? When to buy? I think that will be the questions we're going to answer at the same time. Domestic gasoline inventories are similarly hovering at 3 years high by the end of Q2. So yes, the nationwide commercial gas oil and gasoline inventories, including SOE, fell back to start of year levels by late June due to the sharp run rate cuts and the export suspensions. But what is the truth behind this draw? It was entirely driven by the supply side reductions via the maintenance and the lower operating rates, not by the explosive terminal demand growth. And China's gasoline and gas oil crack spread collapsed to an absolutely 5 years low. We can see that the first half of this year, the gasoline crack averaged a mere 554 RMB per ton. This is already crashed around 52% over the year. In Q3's losses are expected to rise another 21%. So for the teapot, 7 major private refiners will add 30.2 million tons per year of CDU in maintenance and concentrated in June to August. And for those mega privates, the Yulong, they will shut down in mid-June to early July. There's around 10 million tons. And the Shandong Shenghong, we began a 2 months full plant turnaround in late already start. That's in the late June. And SOEs, the Zhanjiang Dongxing added a full turnaround. Shijiazhuang were extended to a late August, and Yangzi petrochemical restarts remained pending. And it will outpace the demands growth rates of 6.3%. So by year 2030, the supply gaps will shrink just 940,000 tons for ethylene. And for propylene, the supply compound growth rate is expected at forecast at 4%, and the demand will grow at 3.7%. This will also narrow the gap, the supplying gap, to 1.35 million tons by year 2030. So consequently, China's reliance on overseas olefins will steadily decline. Yes, we still keep import, but we steadily shrinking the size. And for overseas trade declines, the long-term import growth for naphtha and bulk olefins is highly limited. So I think that will be the key messages to the market. You must pivot your trading focus towards the high value added chemicals and low carbon fuel. So we will continue to stand at the forefront of the data and logic and help you to navigating this speculative transformation in China's energy and petrochemical market.
Before we move on to the Q&A session, I'd like to announce an update of Geo Consulting's core service offerings, acting as your China decoder by turning China's policy and market signals into clear, actionable insights. To that end, we focus on providing clarity to the most pressing questions our clients are facing. We help with below concerns. Global executives and market professionals often ask our team about China into two areas. First, opportunity and global impact. Second, risk assessment and timing. Geo Consulting is structured to provide definitive data-based answers to these questions, leveraging a differentiated approach that transforms ambiguity into strategic clarity. Why market professionals rely on us? Decoding China requires more than just access to information. Our approach is built on three tightly connected pillars. We begin with an in-depth focus on China's policy signals, moving beyond mere explanation to deliver what truly matters against. By leveraging MySeal's proprietary data and consistent market views through analytical reports, consulting projects, and market data, we ensure in reality, helping align policy direction with tangible market behavior. It's not just purely provide an analysis, but translate complex analytics into direct support for critical strategic decisions. To consistently pivot our clients from policy risk to policy reward, we provide these progressive 4 steps to empower our client partnerships, ensuring deliverables at each step is built on a consistent outcome-focused methodology. We recognize that our clients have diverse needs and levels of engagement with the Chinese market. That's why this year we are introducing a new suite of core services, each designed to deliver is required. Our flexible services tiers provide a clear, scalable path for deeper partnership as requirements evolve. In short, each higher tier improves and extends the previous one, deepening decision-making support. We facilitate varied decision-making. Ultimately, our role is to support the decisions behind our clients' China strategy. Whether the question is what to trade, where to invest, which partnership to engage, how to maintain competitiveness, and forecast a shift in supply-demand fundamentals. That's where we come in, translating complexity into clarity and clarity into strategic decision-making. Our unique fusion of policy insight and proprietary data builds enduring partnerships and underwrites major capital decisions. Combining Oilchem's 30 years experience and network in the energy and chemicals market, Geo Consulting has served as an indispensable partner to industry leaders navigating China's complexities. Today's webinar is part of the China Decoder service offering. If you would like to explore how this approach supports your organization's China-related decision-making, you can scan the QR code on the screen to access samples, materials, and request a discussion with our team. Thank you again for joining us today. We are returning as usual in the second day of the APEC week on September 8th. Welcome to a broad cross-source discussion that brings together multiple angles on the topic, oil matters. See you soon this September.